I'm the founder of Young Not Broke, and we're a community for young people to become the boss of their money. I'll be telling you kind of more about who we are and kind of what we do at the end, so just stay tuned for that. But thank you all for coming. This is the second in a series that we're calling Young Not Broke Live. This is kind of a space for us to connect you all with experts in the financial space. So today we have London Cooke of Cooke Wealth Management. Thank you, London, for being here. Before handing it off to you, I'm just going to kind of touch on the structure of the event for today. So I'll be opening it up with some kind of introductory questions that London and I will go through. He's going to kind of go through some principles for investing, especially kind of in an uncertain market. And then after that, we'll be taking questions from you guys. So throughout that time and throughout the rest of the event, feel free to put your questions in the chat, and we'll kind of get to those topic by topic. So Christina here, she's also on Team Young Not Broke. She's going to be kind of moderating those questions. So feel free to put everything in the chat. Awesome. So now handing it off to you, London, let's just start off with a quick introduction.
Yeah, absolutely. Hi guys, London Cooke. I'm based out of Whidbey Island, Washington. Shouts out to the Seattle, Washington folks in the chat. I am relatively new to this business, actually. I graduated from the University of Washington in Seattle. For the following 2 years, worked for a tech firm in Seattle selling software. And then after those kind of first 2 years, I decided kind of wanted to change the pace and to relocate to where I grew up, which is on Whidbey Island. My dad has been a financial advisor for over 30 years and opened his own practice about 10 years ago, and had been pressuring, is probably the most accurate word, me to join the business for a long time. And he finally broke me down. So really happy to be in this business. And obviously these are awesome times to be learning. So I want to kind of talk about where we're at, where we came from in the last few years, where we might be going, and then just kind of give you guys as the biggest takeaway for how you can manage your money, what you can do to start investing if you haven't started investing already, and how that might pay off for you since we are all so young, and we have time on our hands and time on our side. Yeah, go dogs for sure. Okay, so I will start off by talking about where we're at in this economy and in this stock market, and kind of where we came from. So after the 2008-2009 financial crisis, that was the worst recession we've seen in a long time, obviously. I'm sure most of the audience here, and myself included, were really young when this happened. But it was a really serious thing. And thankfully, after we recovered from that, there was the longest bull market in history, the longest economic expansion in the history of the United States. 11 years it went on until late February of this year. And just to kind of give some more context into what that looks like. So as I'm sure you guys all know, the economy works in cycles. There's cycles of expansion, and then there's cycles of contraction. But ultimately, the economy grows over time and always has. This was the longest cycle of expansion. And there started to be some things in the market late last year, definitely early this year, that were possibly signifying that we were kind of near the top of the market. Optimism got a little bit unchecked, left unchecked, I think. Last year, as I'm sure you all remember, there was a lot of bad news coming out. There was Trump's impeachment, which traditionally would have had an effect on the markets, really didn't. The stock market continued to go up. There was the US-China trade war, and still the market seemed to go up. We almost went to war with Iran, which we forget about. That seems like a thing of the past, thankfully. But the market still went up. And traditionally, those are all things that would have taken their toll on the market, and they didn't. The dam really broke loose when COVID-19 kind of hit the U.S. shores, and once we started to realize what effect that's going to have on our economy. And it had a really, really substantial effect in the stock market before it really even started to affect the economy. And what that looked like was from the all-time highs of the Dow Jones in kind of late February, middle February, within a month, the stock market, the Dow Jones in particular, dropped 37% from its all-time highs. And that was by far the most volatile, kind of quickest drop that we've seen in the stock market. But with that has come a pretty serious recovery as well. So as I mentioned, on March 23rd, the Dow Jones was down 37% from its all-time high. Today, it's down about 17% from its all-time high. So more than half of the losses have been recovered on the stock market side of things. And we'll kind of get into maybe why that is and if that's kind of a sustainable recovery. Probably even more kind of mind-blowing, the NASDAQ is down 5% from its all-time highs. And it's actually positive on the year, which is pretty crazy when you look around at what's happening in the economy. And that's where I'm at currently. I'm struggling to juggle the fact that the stock market has recovered more than half of its losses, while I look around and see some pretty grim economic circumstances for America and for Americans in particular. 14.7% unemployment as of April. It's probably more like 20% now. To put that in context, we haven't seen that high of unemployment since the Great Depression. The Q1 GDP of the US shrank by 4.8%. Mind you, the economy didn't really start shutting down fully until 2 weeks into March. So basically, the economy shrunk almost 5% in 2 weeks, which is as severe as it sounds. Forecast for the second quarter GDP numbers GDP is projected to go down 12%. These are really bad things. These are really, really bad numbers. But if you were just watching the stock market, you wouldn't assume that this is what's going on. And as I'm sure, I mean, a lot of you guys are in coastal states, Virginia, New York, California, Washington. I haven't gotten a haircut in 95 days. And everything's shut down. And a lot of these businesses just won't come back. And not to take into account also that there's a rippling effect. I was just reading an article that mortgage late payments jumped by 90% in April, which is the most it's ever jumped. So the question becomes, why is the stock market disconnected from the kind of economic reality that we're seeing? And different people will have different kind of explanations for this. Some people will say that retail investors are having FOMO and kind of pumping the markets up, the fear of missing out. To put that in terms you guys will understand, it'd be like if you're studying at home and your friends are at the local watering hole drinking White Claws and you decide to stop studying and go to the bar to drink those White Claws. That's what we're talking about here with retail investors. So not institutional investors, but rather kind of mom and pop shops. I read an article that stimulus checks overwhelmingly went into the stock market, which means that it could be retail investors that are kind of pumping this thing up. Some people might think that there's going to be a kind of V-shaped recovery, meaning the stocks go down and the stocks go back up. That could be it, but we haven't begun to see how long the economic ramifications of this thing are going to last. I know the Fed or some analysts came out and said that they expect us to not go back to full employment for 7 to 10 years. That's a long time. And to put it in context again, the Dow Jones was at its all-time high in like about midway through 2007. After the 2008-2009 financial crisis came about, the Dow Jones didn't reach that level again for about 5 years. So normally these stock market kind of corrections and bear markets, it takes time for that recovery to happen. So in my view and the view of my coworkers here at Cooke Wealth Management, we think that it is very possible and probable that the stock market will dip down into the negative again before it ultimately gets better. Ultimately, the stock market will recover, the economy will recover. But the question is, what's going to happen in the meantime? So we can talk a little bit about what kind of opportunities that might hold, and maybe why it's not that important, but we'll circle back to that later. So yeah, I think hopefully that gives you guys a good idea of where we've come from, and where I think we're going. Obviously nobody has a crystal ball, so my guess is as good as anybody else's, but that's how I see things.
Awesome. Thank you for that kind of overview and just a little bit of the history and kind of what's going on right now, Lyndon. Before kind of jumping into the other questions, I think it would be good to kind of get a lay of the audience's kind of experience with investing. So I'm just going to launch a quick poll, guys. Feel free to answer this, just so that we kind of know what everyone's experience level with investing is. So that way we can tailor the questions and actually be very helpful to you guys. Awesome. Okay, so we have about like 86% of you guys answer this poll. Let me see if I can share these results. Okay. Can you guys see this? But yeah, so it looks like we're kind of split between people never having invested before, kind of beginner, and then also having some sort of setup with like a Roth or retirement account, and also like some individual investing. So we'll definitely keep this in mind as we kind of answer the questions moving forward. But kind of giving everything that's going on, and especially because there are a lot of people here who, you know, haven't invested before. If someone wants to start investing right now, what are some of the steps that they should be taking?
Yeah, absolutely. And I'm going to keep this based on these kind of poll results. I'm going to try to keep this pretty basic. This might be kind of repetitive for some of you in the intermediate category, and certainly those of you in the advanced category that are probably on all the Reddit forums and are maybe buying puts on the economy. But I think it'll be helpful to kind of just talk about the basics, and maybe even for some of you more sophisticated investors, just to kind of remember what might be more important than some other things. Okay, so I guess the first thing to remember is while investing is generally a really good thing to do, that doesn't mean it's right for everyone in the same circumstances. Because you kind of want to make sure you're financially in a place where investing makes sense. You want to make sure that you're kind of financially sound before you start looking at investing in a Roth, for example, establishing a Roth IRA, and certainly establishing an individual brokerage account. And so what do I mean by that? If you have outstanding balances on high interest debt, I'm talking about like credit card debt, for example, I would pay that off first. And the reason I suggest that is the kind of average interest rate that a credit card charges is 16% a year. It's hard to do better than 16% in the stock market. Some years that's doable. Obviously, you can track the S&P. The S&P last year did 30%. But who's to say how it will do? Over time, it averages more like 9%. So pay that off, and your credit score will thank you. Okay, let's say you've done that. Maybe you have some student loans. Fortunately, student loans are the cheapest they've been, I think, ever. Next year, federal student loan interest rates are going to be like 2.75%. So if you're taking out money to pay for college, now's a really good time to do that. So I wouldn't worry too much about student loans. Okay, but you've paid off your high interest credit card debt, for example. Do you have an emergency fund? Do you have 3 to 6 months of kind of expenses saved up? And where is it? Is it in a savings account? Is it in like a high yield savings account? Is it in cash? Regardless, it's important to have that money on hand, because you never know what's going to come up, and it's important to have money liquid that can kind of meet obligations that come up. Okay, if you said yes to both of those, you have paid off your high interest debt, you have established an emergency fund, I would definitely suggest, and it looks like somebody just asked about this too. If you're gainfully employed, you have a 401k, hopefully you have an employer match through your 401k. Definitely max that out to its fullest. That's free money. Take advantage of that and put as much as you can in to meet that employer match. Once you've met the match, that's where there's really a lot of opportunity to kind of go above and beyond and kind of diversify your investments, and specifically diversify your kind of tax liability upon retirement. What I mean by that is a 401k and a traditional IRA are funded with pre-tax dollars. They're taking money out of your W-2. You're not paying income tax on them. But when you retire after 59 and a half, you are paying income tax on the gains that are made. So there is a tax liability associated with an IRA or a 401k. Conversely, a Roth IRA is funded with post-tax dollars. You've already paid income tax on this money, and now you're putting into the Roth IRA. The benefit of a Roth IRA is when you take that money out at 59 and a half or older, you don't owe any taxes whatsoever on that money. So if you kind of have the dual function of having a 401k and an IRA and a Roth IRA, you're diversifying your tax liability to where you're not paying tax on all of the money that you're distributing upon retirement, which is a really important thing to do, and will save you money in the long run. For a Roth IRA, so that would be my first thing to recommend. And I see some questions about like the 401k and employer match. So some employers will match your contributions to a 401k up to a certain amount. So like my old employer would match up to 3% of my contributions. So when I contributed 3% of my paycheck to my 401k, my employer would match that. So let's say it was $1,200 a paycheck that I put in from my earnings. My employer would also give $1,200. They're not going to just match you like you can't just put as much money you want in there and they're going to match you. They're going to have stipulations onto what that looks like. Some will like match at a 50% level, like meaning to say if you put in $1,200, they'll match you with $600. It's really employer by employer. Unfortunately, some employers don't offer matches, in which case I would suggest trying to put 5% of your earnings into a 401k, and then maxing out your Roth IRA as well. No taxes paid on a Roth IRA after retirement, as long as it's a qualified distribution. Anytime it's after 59 and a half, no taxes due on Roth IRA, which is the difference between 401k and a Roth IRA, for example. I'll circle back to some of these questions at the end here. Okay, so what is a Roth IRA and why is it important? I think we've kind of covered those. What should you do about it? Let's say you've said yes to all the questions I've asked. You're maxing out your employer contribution. Now you need to look at establishing a Roth IRA. And I'll talk a little bit about what that looks like. But something to keep in mind here, especially for something like establishing a Roth IRA, is I know timing the market and like buying the dip is like, it sounds really cool and like very Wolf of Wall Street and seems badass. When we're talking about money that's going to be sitting in this account for 40 years untouched, the important thing is not that you're buying the dip now. The important thing is that you're being consistent with the money you're putting into this account. So the contribution limits on a Roth IRA, for example, are $6,000 a year for people in our age bracket. If you could give $500 a month to your Roth IRA, meaning $6,000 a year, that would be such a great position to put yourself in 40 years from now. If you could do that for the next 20 years, that would be a considerable amount of money. I'm talking more than $1 million just in that account alone. And with that, I would suggest that you try to take the focus again away from buying the dip, because when you're putting in money for such a long time, time and consistency is really the key here. And if you could, for example, put $500 in a month, you're going to be doing something called dollar cost averaging. It's not shiny and cool, but dollar cost averaging essentially means that you're taking the volatility out of the buying process, because if the market goes down and you that month are buying, you're putting 500 into your $500 into your Roth IRA, you're buying stocks at a low price. You're getting more stock for the same amount of money. That said, if the market goes up, then you're getting less stock for the same amount of money. And in that way, it kind of results in this average where you're decreasing the volatility and you're kind of buying decision making. So that would be like my biggest takeaway. I know maybe the marketing material where it was a little bit like kind of painted the wrong picture, but that's what we want to do. We want to kind of draw you in with that. But the takeaway is that if you can be consistent and you can do this for a long amount of time and just kind of adhere to the fundamentals, that's going to make the big difference in the long term. Okay, so we've covered kind of the Roth. If you're maybe a more sophisticated investor, you're maxing out your Roth, you're giving to your 401k, you're maxing out your employee contribution, employer match. Then maybe you can look at establishing an individual brokerage account. What that is a fully taxable account. There's no tax advantage to one of those accounts. And this is where you could kind of get creative, and you could actually worry about like buying the dip. I'm sure the people in the advanced category that answered advanced to that poll, they're doing this, I'm sure. Robinhood is one option for kind of investors that want to use an individual brokerage account. And I mean, really, I'm not going to touch into that too much because I don't want to give kind of blanket statements about any specific products or anything like that. But I would say for you guys, it's important that you kind of check all those other boxes before you start looking at maybe establishing an individual brokerage account or the like. Okay, hopefully I covered that. I don't know if you guys are kind of aggregating these questions. I see a lot of questions going through here.
Oops, on mute. Yeah, we've been kind of aggregating them. So let's kind of go through those questions. I think you gave us like a good overview. So we've had some questions on kind of when you should be investing. So some people say to hold off on investing until you have a stable emergency fund and max out your 401k, whereas others encourage you to work on all of them concurrently. Thoughts on this?
Yeah. I mean, it's really up to your kind of, I've lost the window here. It's up to your kind of budgeting, I guess. If you can give to a 401k and a Roth at the same time, while maxing out your employer match and maybe meeting the 6,000 annual contribution Roth IRA limit, then that's an awesome place to be in. And if you can do both of those things and you still have discretionary income, then maybe it would be appropriate to look at kind of other investment vehicles, maybe establishing an individual brokerage account or the like. But I think it's kind of a flow chart in that way. You need to prioritize your first your high interest debt, your emergency fund, then retirement, and then other retirement vehicles like a Roth IRA. And then you can start to do the fun stuff and buy Delta when it's $20 a share or whatever you want to do.
Awesome. So kind of stemming off of that, advice on how to pick funds or just kind of do auto investing through something like a robo-advisor and forget about it.
Yeah, awesome question. Yeah, so there's kind of like three ways you can go with a Roth IRA in particular. With a 401k, there's going to be a plan administrator that offers you a set amount of funds. Usually it's like 15 to 20 funds. And normally how it works is there's target date funds. So like based off of the data at which you will retire. So like for me, it would be like 2055, hopefully sooner, 2055 target date retirement fund. And they would adjust the equity and fixed income exposure in that fund based off of your retirement date. But great question. For a Roth IRA, you don't have somebody like giving you 10 to 15 funds to choose from, and there might not be retirement target date funds to choose from. The benefit, okay, well, so there's kind of three categories for opening a Roth IRA. I guess I should go into that first. The first is kind of a self-directed account. You can open those at any of the major brokerages, TD Ameritrade, Charles Schwab, uh, those kind of names, Fidelity. Then there's the robo-advisor. Robo-advisors are software programs that will take in a bunch of variables like your age and your risk tolerance, things like that, and then will place your money in funds based off of your answers to those. Generally speaking, robo-advisors will charge you like 0.25% in fees, whereas the self-directed won't have that kind of annual charge usually. Betterment, I think, is the most popular robo-advisor. And then the third option is working with a financial advisor, because I got to get paid too. So this might not honestly be the best option for a lot of young people, because what you're going to be doing isn't going to be that complex. And I can talk a little bit more about why that is. But as you get older, as you have multiple accounts, as maybe you have kids and you look at setting up college savings accounts, maybe you want to create a trust, maybe you want to have a joint account with your significant other, that's where it'd be more appropriate to talk to a financial advisor, to have like a trusted contact that you can really turn to and that knows your complete financial situation. If you're working with a self-directed account or a robo-advisor, it, of course, is going to be cheaper, but it's not the same level of kind of comprehensive approach. But that might not be necessary. And because when you're young, and let's say you have 45 years to retirement or 40 years to retirement, investing in a Roth IRA or a retirement account is going to be really simple. Because you're so young, you can take on a higher amount of risk than somebody that's nearing retirement. Because you're so young, you can essentially buy the S&P 500 index, for example, and just continuously contribute to that. And that over time has averaged about 10% a year. Like I said, last year it did like 31%. Last year was an extraordinarily good year. But because you're so young, you can kind of take that risk on and reap the rewards of kind of building off those gains. And then as you get older, that kind of risk needs to be adjusted and the portfolio mix needs to be adjusted. And you need to stop maybe buying into so much equities and instead buy into more fixed income vehicles. And that maybe is a time when it would make more sense to work with a financial advisor, for example. But really, like if I was to give like a blanket piece of advice, if you're in your 20s and you have a Roth IRA and you're wondering where to put your money, just look at like S&P 500 ETFs that track the S&P 500 index. That's a really good place to start. There's a ton of information online on different products and stuff like that. But I think a lot of times in this business, people in my industry make this a lot more confusing than it should be, because it means that we get paid, and it means that you need us. But a lot of this can be done yourself if you have like the will to learn about it and the will to practice kind of discipline and adhere to the fundamentals of investing. And that's what's important.
Awesome. So we just have a clarification question on that first question that I asked you about kind of what the order of prioritization should be. So should we prioritize high interest debt, emergency fund, and retirement accounts before contributing to an individual brokerage?
Correct. In that order.
Cool. Awesome. So a question on kind of recommendation and fees. So I'm an incoming student after having worked for a few years. Of the below, which do you recommend for managing my 401k, Roth IRA, and employee stock option? So they listed a bunch of different things. So Barclays, Chase, Charles Schwab, Discover, Wealthfront, Robinhood. But I think maybe more generally speaking, kind of what fees should people be aware of between kind of like an individual brokerage versus something like Wealthfront or Robinhood or, Betterment, things like that?
Yeah, awesome question. So when you work for a company, you don't, as an employee, you don't have a say in terms of who does your 401k. It's just going to be a company that the higher ups have decided to work with. At my old company, that was Vanguard, for example. That said, when you leave that company, when you kind of part ways, then you have kind of a decision to make. One, you can keep it where it's at. I did keep my money at Vanguard, for example, and you can roll that over at any time. So, and I don't want to get too in the weeds here, but you can roll over that 401k money into an IRA. You could roll it over into a self-directed IRA, for example, where you're not paying any fees on it. I'm honestly not super familiar with the fee structure of 401ks, and it really depends on the size of the company and what kind of deal they cut with the 401k provider and what options they have, things like that. I would say about 1%, maybe 0.5% to 1% is a good range to think about where that is. And I think that would be off of, yeah, I don't even want to say, but so that's something to keep in mind. If you're doing a self-directed, let's say you leave that company, you roll over that 401k into a self-directed IRA, you're not going to be paying like an annual charge for the most part. That said, if you roll it into like a robo-advisor account, you're probably going to be paying 0.25% of interest a year. If you roll it over to a financial advisor, depending on the firm, I would say we have a very good value proposition. But some financial advisors charge more like 1.5% a year. Some are less, maybe like 1%. That kind of gives you an idea of what the general kind of fee structures are.
Cool.
And as far as, sorry, I just saw names of fees that you should be expecting. This is another thing that the financial industry does really horribly. They make it very hard to understand what you're paying for. They're not transparent. It's a really skeezy thing to do. So unfortunately, you kind of got to comb through the statements. You got to read as much as you can because they will try to slip it in there.
All right. So now we're moving on to a ton of questions that we have on Roth IRAs. So my Roth IRA is showing less money right now than the deposit amount. Should I be worried?
Yeah. Yeah, you should probably call somebody about that. The only way I can think that would have happened is if you were leveraged in some way, essentially borrowing money through your Roth IRA. I don't know how that would have happened. It honestly could be a mistake. So I would contact the firm about a negative balance in a Roth IRA for sure.
What about if like the money had just not performing as well, so it's like less than how much you initially?
Oh, I understand.
I think that's more.
Yeah, understood. Yeah, that's a really good question. And obviously it's very scary to, like, let's say you put in $6,000 in February, early February, and to see it go down like $2,000 to where you're sitting at like $4,000. And I know that really sucks. But like I mentioned before, because we're so young and because we have such a long time horizon, you're going to make up that loss over time. And as I mentioned before, the stock market usually averages about 10% a year. It won't this year. It won't do 10%. We'll be blessed if it ends up positive at the end of the year. But over time, it does 10% a year. So keep that in mind. Keep the time horizon in mind. Honestly, I would suggest do not check your 401k. Do not check your Roth IRA balance. Just control what you can control. Put in money regularly, budget well, and keep your kind of eye on the prize that's 40 years from now. Don't worry about the day-to-day. It's not going to do you any good.
Awesome. For current college students who are working internships, should we max out our Roth IRA, or should we wait to kind of contribute to a 401k once we have a full-time job? A related question is, should students graduating soon be maxing out their Roth IRAs or putting money towards an individual brokerage?
Yeah. So the first question, for interns. Some internships will allow you access to the 401k plan. Others won't. I would say it's more common that they won't give you access. If they do allow you access, definitely take advantage of it and contribute to the 401k. If they don't, how it works with the 401k is if you don't contribute with your pre-tax dollars, that's your only chance to do it. So it wouldn't be like you could take your money you made from your internship and then like next year put it in your 401k. That's not how it works because it's funded through pre-tax money. So in that case, if you don't have access to your employer's 401k as an intern, you're getting paid and maybe you have a lot of discretionary income. You paid off your high interest debt like we talked about. You built an emergency fund like we talked about. Awesome time to look at funding a Roth IRA. You'd be doing yourself a favor, and by the time you hit the full-time workforce, you're already going to have a Roth IRA that maybe had a couple years to grow, and you've already kind of like built that good habit. So definitely recommend that.
All right, awesome. What's a backdoor Roth? Something I've heard a lot of people talk about.
Yeah, a backdoor Roth. So with a Roth IRA, because there's such tax advantages to them, there is an income cutoff. It's in like the upper 100. It's like 180 grand or something a year. If you make more than that, then you're not eligible to give to a Roth IRA. The backdoor Roth IRA gives you an ability to kind of get around that. I don't want to get too deep into it. It'd be really getting into the weeds. If you make less than 150K a year, which I assume most of us do, you don't have to worry about that.
Cool. Would you still recommend a Roth IRA for those planning to retire early?
Good question. I would, but with the stipulation that without incurring tax, kind of a tax liability, you're not going to be able to take from it until 59 and a half. So you can absolutely donate to or contribute to a Roth IRA, but just know that you're not gonna be able to touch that money until 59 and a half. But if you're retiring at 35, you're not gonna be able to touch it for a while. But honestly, that's probably a good thing because if you're retiring at 30, it's a lot bigger chance you're gonna run out of money. So I would still definitely recommend doing that.
Awesome. Moving on to some kind of 401k related questions. I have a 401k set up by my company. Should I adjust anything in that 401k now that the economy is going down?
Good question. Yeah, really good question. You could, and this would be kind of up to your own investment thesis. Like I already talked about, I think that the stock market is most likely going to go down. So if I was in that kind of boat, let's say I'm contributing to right now a fund that's 90% stock, 10% fixed income investments. If I thought that the market was going to go down, I could move all of my money in my 401k today into like cash, even for example. Then when I thought it was the bottom, I could then buy into like 100% equities. So essentially I would be missing the downturn, buying the bottom, and then riding the upturn. I don't recommend you do that because like I mentioned before, it's very hard to time the market. 401ks are very clunky. They don't make it easy to make adjustments most of the time. And sometimes they won't allow you to make adjustments or they'll put a limit on how many adjustments you can make. Like I mentioned before, the kind of principle of dollar cost averaging is important here. If the market goes down, you're going to be buying stock at low prices, at more favorable prices, just as a factor of you getting paid every 2 weeks. So that's what I would focus on. If you're a little bit more of a sophisticated investor, you can call your 401k company and see what options you have to maybe switch around your funds and get creative with it. For the kind of average investor, I really wouldn't recommend it.
Cool. I worked at a job for 2 years and had a 401k through that, but now I am in grad school and not contributing to that account. Should I just leave my money where it is at, or at some point should I move it? Another related question is kind of like, should I leave my 401k with the firm that my former employee chose, or move it to one of my accounts? And yeah, I think that's a question. Is like, should I move it? Things like that.
Yeah. It's going to be a case-by-case basis. I'll tell you what we tell most of our clients. If something horrible happens and that company goes through bankruptcy, it's still your money. You're still due that money, but they sometimes will do lockup periods on 401ks where you can't do a rollover or you can't make a withdrawal. So I think it's a good practice to most of the time roll that money out of your old employer's 401k, roll it into an IRA, or roll it, if you have a new employer, you can roll it into that 401k with the firm that they use. I think that's a good practice to be in. It's a good thing to consolidate your accounts so you don't have stuff scattered all across the board. Yeah.
What about the trade-offs between kind of like when you do rollover and the fees that you might have to pay and kind of deciding whether or not that's worth it?
Yeah. Good question. I mean, if, for example, if you rolled your 401k over from an ex-employer into a self-directed IRA account, you will be saving on fees. It's not going to be a ton of money. It's probably going to be negligible in the long run. Between employers, it's probably going to be really comparable. It'll really be a case-by-case basis, though, depending on what firm you're working with and what deal they have with your employer.
Cool. Do you recommend focusing on just maxing out a 401k or splitting retirement money into both a 401k and Roth IRA? So kind of like diversify tax liability or dedicate efforts to just one account is the question.
Awesome question. I'm glad whoever asked that. That's a great question. I would say once you've met that employer match, if you do have one, I would say from there, it's a good idea to start diversifying for the reasons we talked about, to diversify your tax liability upon retirement. Yeah, I definitely would suggest that. Use your employer match to the fullest, and then look at opening a Roth IRA and kind of have those two streams of income upon retirement. Puts you in a much more favorable position.
Awesome. So now a few questions on kind of investing specifics. So can you talk more about the risk level of the S&P 500? Would you consider it to be low or moderate risk?
Good question. I mean, it's all relative, right? I would say it's more high risk, honestly, compared to a lot of other investments. Obviously, it's 100% stock. It's the biggest 500 companies in the U.S. It's more high risk, high reward in that way. But the thing to remember is if you're of the 20 to 25 kind of age bracket, you have a lot of time to take on that risk. Now, if you were 55 and thinking about retiring in a couple years, definitely wouldn't invest all your money in the S&P 500 because you don't have time to make up the gains or the losses that come with a correction like the one we're currently in. But when you have 40 plus years on your hands like we do, S&P is probably one of the best bets out there.
Cool. Thoughts on investing in real estate, so industrial, REITs, etc.
Yeah. So REITs are called real estate investment trusts. They basically give you a way to invest in real estate without having to buy an apartment building and fix people's faucets and whatnot. Yeah, it's a good question. We don't use REITs a lot personally. Most of our clients that invest in real estate do it by buying real estate in the flesh. That said, REITs give you an opportunity to get kind of regular income, and they give you a way to enter the real estate market without having the kind of obligations of owning a property. Don't want to give any really specific advice or specific products. I would say that I probably wouldn't be investing in them now, just because I think a lot of people are going to have, especially kind of commercial REITs. I think a lot of businesses are going to go out of business and commercial properties are going to be hurting. But that's just my kind of 2 cents on that.
Cool. We have a couple of questions on kind of stock options and employee stock programs. So how should we approach stock options if our employer has a vesting schedule? Should we diversify immediately upon receiving company stock or wait? I also think it would be good to just define what they are before you kind of answer.
Yeah, totally. So an employee stock purchase program allows you to buy stock in your employer, usually at a discount, maybe like a 15% discount. Also, there's kind of like signing bonuses where you get restricted stock units, RSUs. Most tech companies will like give you a vesting schedule over like 3 years, let's say, where they're going to promise you this much stock. You'll get 200 shares after your 1 year anniversary. You'll get from there, you'll get 50 shares a quarter until the 3 years are out. Those are awesome programs, but only if you believe in your company and you believe in the long-term success of the company. If you don't, then you probably don't want to be holding their stock anyway. If you do believe in the long-term success of your company, it's really a case by case, but I would suggest diversifying some of that. Once you have those RSUs they've vested and they're under your control, I would think about diversifying some of it. That said, if you work for a cloud computing software company right now, they're the only ones that have held up in this whole thing. The DocuSigns and the Zooms and they're all doing fantastic. So, I mean, you got to make a choice there. You got to make a choice.
Cool. So I'm going to pivot back to some Roth IRA questions because that seems to be a hot topic for us. So I've been working for a year and I'm going to grad school for the next year until May 2021. Does it make sense to put $6,000, so basically maxing out that Roth IRA now, or should I just wait until I start working again?
I would do it now. If you have the money and you kind of check the boxes that we talked about before, I would do it now. That's another 2 years, 3 years, 4 years for your money to grow. And you're buying in at a 15% discount of where prices were 3 months ago. I'd do it now.
This is kind of like an international account question. So if I have money in an international account, can I contribute that money to a Roth IRA account in the US? Would it have any tax implications?
That's a complicated question. I'm not sure. I honestly don't know. We don't work with many international clients because we can't. So you would have to ask probably your bank that you work with. It's going to be a country by country basis as well. For the Roth IRA, it's post-tax money. So the federal government isn't going to give you a tax advantage account and tax advantage income without you having at some point paid taxes on it. So I would say probably no, unfortunately, to that question.
Cool. When should we be using a self-directed IRA?
Yeah, I would say if you're a more sophisticated investor, you feel comfortable picking the funds in which your contributions are going to go, and you're willing to make adjustments as necessary. That's when a self-directed IRA will be most appropriate. Obviously, you'll save on fees with the self-directed IRA. If you don't feel as comfortable, then maybe a robo-advisor would be a better fit. Or if you really want an incredible level of service, you can give me a call. But yeah, kind of up to your own circumstances.
Cool. If you don't have a Roth IRA or individual brokerage account, should you open these accounts up with the same place your employer has their 401k, like just for the sake of efficiency, or pick somewhere you like, even if that means accounts in different places? You might have touched on this one earlier, but.
No, I don't think I did. They won't, you can, like, let's say you have a 401k at Vanguard through your employer and a Roth at Vanguard. I don't think they'll even allow you to, you're going to have like 2 separate like logins, and they're not going to be like consolidated just because it's like the employer's account on one side and like your own account on the other side. So it's really up to you. Like if you feel comfortable with like a Vanguard, then by all means do that. But I wouldn't let that be the deciding factor.
Cool. So we have some kind of fun questions. Thoughts on the FIRE movement? So financial independence, retire early.
Yeah. I love it. I mean, I love that. I love what Young Not Broke is doing. Like I mentioned, it's like there are barely any resources, especially for kids in high school or kids in college. There's such little resources available and information available to educate people on their personal finance. and especially young people. And the FIRE movement definitely does that. And it tells you the importance of budgeting and saving, that's the name of the game. So yeah, I think it's great.
Cool. So it seems like trading on the phone while sitting around at home or even on the go has been trending recently. Apparently, all you have to do is copy and paste the signals master traders send to phones and become profitable from the market. I'm personally skeptical and have no idea what this is. Does anyone know what this is exactly?
I'm trying to find that so I can read what I'm even hearing here. No, don't do whatever. No, don't do that. Don't believe anything you read online. No, definitely don't do whatever I don't even know what you mean. Don't do that.
Cool. So kind of like when we're talking about researching accounts and trying to figure out which one to choose, is there any kind of big difference between the different like robo advisors out there?
Not that I know of. Obviously, I'm not super familiar with them. But no, I don't think there's a huge. I was reading a NerdWallet article that I thought was super helpful. If you just Google NerdWallet Roth IRA, gives you a great kind of like rundown of kind of the best in breed of the different robo advisors and maybe the best brokerages for self-directed. I think they're all going to be relatively similar, and I think the fee structures are relatively similar.
Awesome. Any specific like metrics people should take note of when researching? So like performance of companies, expenses. I'm guessing this question is kind of about individual stocks, but
Yeah.
whoever asked this, correct me if I'm wrong.
Yeah, good question. I mean, for a retirement account and for a Roth IRA, for example, I wouldn't suggest buying into any individual companies, just because it's you have a long time for your money to grow, and diversification is kind of the name of the game. That said, when I look at stocks, I mean, obviously the price to earnings is important. It's important to kind of look at the technical charts and see what the price movement has been like. But these days, it's things can kind of be decoupled from reality. I mean, you look at like a Tesla, for example, that like the price quadrupled last year. There's a lot of like speculating and stuff going on, so be wary of that as well. Don't let FOMO be the primary reason why you're buying a stock. I mean, for instance, like there's this Nikola Motors that's supposed to be a competitor of Tesla, and there was a lot of like, I'm seeing this on TikTok, for example, so it's like wrong, and that we're reaching the pinnacle of kind of investor optimism, but yeah, just be wary of kind of things that look too good to be true, and overly optimistic, or anybody who promises you returns. Nobody has a crystal ball, so there are no promises in this game.
Awesome. So we're almost at time, and so I'm just going to kind of ask a final wrap-up question. There can be kind of fear and anxiety in terms of just kind of making the wrong decision, especially when you are a first-time investor, right? Is there a point where you should just kind of like take the first step, stop researching, just kind of do it? Or are there kind of maybe steps or questions people should ask themselves to make sure that they're ready before they start taking that step?
Yeah, really good question. I think obviously it's hard to put your kind of hard-earned money out into the world and let your little bird fly the nest. So obviously there's emotion involved. But the important thing, and I hate to keep harping on this, but the important thing to remember is to be disciplined, to try to be as objective as you can be, and to be consistent. With the benefit of 40 years on your side, one little blip, even the coronavirus will be a blip in retrospect. So just kind of try to keep a long-term view. If you're let's say you're like in an individual brokerage account, and you're betting on, you're buying like Tesla puts, you're betting the price of Tesla is going to go down. Be prepared to lose all your money. Like if you're making speculative bets, only do so knowing that it's possible you might lose your money. And I'm only speaking for like an individual a brokerage account, somebody that's really trying to get rich quick. Just at that point, it's a gambling thing. So just be aware of that as well.
Awesome. Thank you so much, London, for answering all of our questions today. So as I said earlier, I'm going to just tell you guys a little bit more about Young Not Broke. So this is just the second in our series of live events that we're doing right now. So we have a ton more coming up. To stay tuned and kind of get those updates, the best way to do so is by subscribing to our newsletter. So head over to youngnotbroke.co. Apart from these live events, we also kind of break down financial concepts. So we'll also be sharing a ton of blog posts and kind of what London talked about today. We actually did a 3-part series on kind of the basics of investing. So feel free to check that out if there was anything today that we talked about that you were kind of confused about. But yeah, it's the best way to reach us. And check out our newsletter. And then if you have any questions for us, you can reach us at hello@youngnotbroke.co. And then London would love to kind of share your contact info too if you guys have questions for him. So you can reach him at london.cooke@kmsfinancial.com. Anything else you'd like to share today, London?
No, I don't think so. I really appreciate what you guys are doing, and I'm really happy to support where I can. And I'm really happy that you guys are on this call and are interested in educating yourself. That's really important. So shouts out to all of you. And I know there's probably nothing better to do, but I'm glad you joined us.
All right. Thank you so much, guys. We'll stick around if you guys have any questions, but y'all are free to go.